everyone, welcome to another episode of Trading Kaki's weekly series. We took a mini break last week and a lot of things have happened and we're now back with more updates for you. This week, Fed Chair Jerome Powell gave 2 consecutive days of testimony on the interest rates path, and what's interesting about this testimony is that it was a total market changer, given that initially the entire market was kind of expecting peak interest rates. In this particular testimony, it was mentioned that the Fed is prepared to increase the pace of rate hikes, especially with the latest economic data, particularly the labor data, coming in much stronger than expected. And true enough, on Friday, when the non-farm payroll data was released, it was a much hotter jobs market than expected, with over 3,000 new jobs being added. This was much higher than what was forecasted. On top of that, we have unemployment rate coming in at 3.6%. Even though this is slightly higher than what was forecasted, we actually have to take this into context with the entire labor force participation rate, which was the highest since March 2020. As you recall, that was the period where COVID struck right hot on the heels. So if we take the much bigger labor force participation, the unemployment rate is actually reflective of a very tight labor market. These are the key macro events happening next week. So for us, we are keeping a watchful eye, particularly on CPI, which will give us a good guide on where inflation is headed. Taking a look at how the markets have fared, you can see that there has been a continued downward shift, especially after the Powell testimony, and is currently broken out of the downward channel with the next support level at the 3800 level. As for the Dow Jones Index, it broke out of the consolidation channel and is currently trending downwards, with the next 2 support levels at 31.7 and at 31. The Nasdaq closed at the lower bound of its downward channel and the next support level is at 10.9. The small and mid-cap stocks, which are under the Russell 2000, almost wiped out the entire year-to-date gains, with it breaking out of its downward channel, with its next support at 1725. Volatility spiked this week with the VIX increasing more than 30%. In fact, on Friday, it almost reached an intraday high of close to 30, which is a level that's not been seen in over 3 months. It closed way above its 200-day EMA at 23.2. As you recall, in our previous video, we actually mentioned that there's been this 50-cent VIX trader, basically someone who has bet more than $8 million that the volatility was surged to 50 in May, so that person is probably smiling right now. The dollar index retraced back below its 200-day EMA, however, it's still within its upward channel. Despite a slight relief last week, China-US tensions continued to persist. On top of that, this decline is reflective of the GDP growth target that was set during China's 2 sessions annual meeting last week, which was at 5%, and this was much lower than what market had expected. Spreads between the 10-year yields and the 30-year yields continued to widen this week, and this is continued reflection of a recessionary fear. There was a sharp correction in cryptocurrencies this week, with Bitcoin and Ethereum both wiping out more than half of its year-to-date gains. The next support level for Bitcoin is at 19.5 and the next support level for Ethereum is at 1.35. Consumer staples, utilities and technology were the key sectors holding up the market. On the other hand, the losing sectors were real estate, materials and financials. For financials, there was a key reason for this decline, which was the collapse of SVB or Silicon Valley Bank, which we'll cover next. You're probably seeing the name SVB or Silicon Valley Bank being splashed all across the headlines right now. SVB is a bank that counts many startups and VC firms as their clients. So what actually happened? On Friday, SVB was shut down officially by US banking regulators after more than $200 billion of its assets were seized. The assets were seized by the US Federal Deposit Insurance Corporation, or the FDIC in short. Basically, this is a governing body that will insure customers' deposits. However, there's a limit to this insurance at $250,000 per depositor. It's currently unclear how many of these deposits are above this insurance limit. What's playing out right now is a classic case of a bank run where depositors rush to withdraw their deposits from banks in the event of a failure or anticipated failure of the bank, which is the case of SVB's collapse currently. Its capital reserve ratio is way too low. It has to sell its fixed income securities at losses in order to fulfill the demand of this onset of withdrawal or mass withdrawal. Let's dial the clock back to assess how this happened. We can liken the current scenario to that of a duration mismatch or maturity mismatch, where the terms of a firm's assets do not align with those of its liabilities. This is especially important for banks, as generating net interest income is their main business model. In the instance of SVB, during COVID, which was before the rate hike cycle, its clients, which are mostly startups and VC firms, generated a ton of cash, which led to a surge in deposits. And at that point of time, the deposit rate was at a near zero rate. It lent out loans at a higher rate to earn interest income and also bought a large amount of US Treasury bills or T-bills and government-backed mortgage-backed securities. These securities are virtually risk-free and at no risk of defaulting, so they will not present an issue to the bank unless they were to sell it on the open market. So currently SVB is facing pressure to sell it on the open market, as most of its customers are withdrawing these deposits as the current fixed deposit rates are lagging the key rates, and because they have purchased a large amount of these securities, they are selling it at a huge loss. Taking a closer look on SVB's balance sheet or financials, you can see that their unrealized losses were at close to $15 billion and its total equity is at $16 billion. So in an extreme scenario like a bank run, the losses will almost wipe out the entire shareholders' equity value. As the bank scrambles to raise capital, there's been reports of a potential sale of SVB. At the same time, FDIC may arrange for the sale of its insured deposits and other assets to another healthy bank. Back to why we mentioned financials was the most hit sector this week. This issue is not unique to SVB and could very well happen to the bigger banks as well, which could produce a sort of contagion effect. Customers will panic if they are unable to get back their deposits, which may lead to mass withdrawals at other banks. If you look at the unrealized loss over total equity across the major banks in the US, you can see that Bank of America follows very closely after SVB. We do not have any stock picks this week as we wait the turn of this current crisis. A new cycle will emerge, so be patient and we will monitor how the SVB situation fares. That's all we have for this week. We hope you enjoyed the content. Please like, subscribe and stay tuned for our next release.